Good evening. My name is Dr. Katie Mateer, and I'm the Associate Vice President for Academic Planning at the University of Victoria, and I would like to welcome you this evening to the university. We are very pleased that so many of you have joined us for the President's panel on the economy, markets, money, and the meltdown. We are living in a global financial crisis of unprecedented scope and proportion. Under the auspices of the President, we have brought together a panel of experts to shed light on the issues, the challenges, and the implications for each of us. We hope that you will find the evening informative and thought-provoking. I also wanted to let you know that the session is being taped and will be available for view on our website very soon. And now it is my great pleasure to introduce the President of the University of Victoria and the inspiration for this panel, Dr. David Turpin.
Thank you, Katie, and good evening, ladies and gentlemen. Welcome to what promises to be a very interesting evening. Welcome to the University of Victoria panel discussion, Markets, Money, and the Meltdown. Thank you all for being here. As the President of the University of Victoria, I'm pleased to have this opportunity to showcase the expertise from within our university and from the broader community. Universities have as their mission the creation of knowledge through our research, the transmission of knowledge through teaching and outreach, and the application of that knowledge, all for the betterment of society. At the same time, our university is ready to step forward when there are issues of major concern to our community and to the world. There is no doubt that the current global economic situation is of great significance and a great concern here at home and abroad. After a long period of steady economic growth, the world has entered a period of financial turmoil not seen in most of our lifetimes. Because of the interconnectedness of modern globalized finance, the shock waves are now being felt around the world. So where does this come from? How did this happen? How does this current situation compare to situations in the past? How significant is this likely to be? How long is it likely to last? And can we ever return to the growth of the past decade? These questions are being asked around the world, and this past weekend, the G20 met in Washington to try and find solutions. The G20, as Jeffrey Simpson reminded us in this morning's Globe and Mail, was really based on a Canadian idea, with the University of Victoria playing a major role in its development. We can rightly acknowledge the foresight and wisdom of our colleagues in the Center for Global Studies who contributed to floating the original idea. As a consequence, over the weekend, as Jeffrey Simpson said, and I quote, "The world's political infrastructure for discussing and perhaps someday reforming international economic architecture has changed forever." That is the global picture. And where do we stand here in Canada, in British Columbia, and in Victoria? While there may be some agreement about the origins, the implications and the way forward are far from clear. So here's a prime example of how universities are uniquely placed to help address important questions. And at the University of Victoria, we are pleased this evening to fulfill our obligation of connecting the local community with our scholarly expertise and the talent from this region. For this evening's discussion, we have assembled a panel of experts with knowledge of international finance, central banking policy, commercial lending, real estate, and pensions. Each panelist is a member of the broader UVic community. None has a crystal ball. But over the next 2 hours, we will come all to better understand where we are and where we might be headed. Before I introduce the moderator for this evening's panel, I want to acknowledge and thank the organizing team who, in a very short time frame, have put this evening together. Please join me in thanking Katie Mateer and her team. Thank you, Katie. I would also like to especially thank our sponsor and partner for this event, the Times Colonist. This year marks the 150th anniversary of the TC, making it Western Canada's oldest daily newspaper. To moderate tonight's panel, I am pleased to introduce Lucinda Choden, Editor-in-Chief of the TC. Prior to joining the Times Colonist, Ms. Choden spent 20 years at the Montreal Gazette, occupying positions that include Deputy Editor, Readership Development Editor, and Senior News Editor. Colleagues and friends, welcome to the University of Victoria's President's Panel on the Economy, and please join me in welcoming our moderator, Lucinda Choden.
Thank you, David, and good evening. It's a great pleasure to me to be here tonight on behalf of the Times Colonist, because we see this event as a very important and significant event for our community. Because what's happening to the economy, both globally and locally, affects all of us. As stock markets tumble and economies move into recession, even the most seasoned observers have been amazed at the speed of the transition, the woes of the financial markets in the US, and the radical policy interventions that are now being considered. A headline about Citigroup in today's newspapers gives an excellent sense of the sea change that has occurred. This is the headline. Last spring, it was the largest bank in the world. Yesterday, it cut 50,000 jobs. Canada has been in an unusual position in the face of this change. Until very recently, huge increases in commodity prices had led to record high government revenues and record low unemployment rates. The Canadian dollar hovered around par with the US dollar, pressuring manufacturing base in central Canada, but also moderating the effect of the commodity prices on Canadian inflation. Across the country, the housing market was strong. Most observers felt the appreciation in housing prices that we were seeing was based on strong employment, not on the faulty lending practices that had fueled the US bubble. Now, as the world economy slows, commodity prices have collapsed, taking Canadian stock indices and pension plans with them. Housing starts have fizzled, and house prices have started to fall. The dollar has plunged, but with the auto industry teetering, this has provided cold comfort to the manufacturers in Ontario and Quebec. Even the federal finance ministers talked about selling assets to avoid a deficit. Tonight, we will be hearing from 5 panel members who are all connected with the university and this community. They're going to be providing us with context for the financial situation the world is facing and help us understand how it affects our government and community and how it translates into bank policy and lending practices and our own real estate investments and pensions. I'd like to talk a little bit about the format so you understand what you'll be seeing. There's going to be a 10-minute presentation by each speaker. That will be followed by a question period. That was going to be facilitated by Dr. Paul Schur from the university. If you did not drop your question into the boxes as you entered, please pass it along now to the ushers. They and the students who are volunteering tonight will collect and collate the questions, and the moderator will be asking them on behalf of the audience. A final note about the logistics. Because we want to be sure that there's enough time for your questions to be answered, I will be keeping a firm eye on the clock. The speakers tonight will each hear a little beeping as they end their 10-minute presentation. That will be a signal to them to sort of begin winding down their remarks. And I'm sure, given the quality of the speakers, I won't have to employ anything more drastic than that. A final request before I invite them to join us on stage. Please mute your cell phones so that everybody can enjoy the presentation without interruption. Now, I'd like to invite the panelists to take their seats. Panelists? Our first speaker tonight is Dr. Bosman Viterbi. Dr. Bosman Viterbi is assistant professor in the Faculty of Business. She will be giving us a brief overview of the financial situation. Bosma's area of expertise is finance. She teaches international finance and corporate finance. Her teaching interests also include investments, financial markets and institutions, and risk management and derivatives. Before joining the University of Victoria Business Department, she taught various finance courses at McGill University. Bosma?
Thanks very much. Good evening, everyone. I'm very pleased to be here tonight. I will start this debate with a brief overview of the current financial crisis, which will provide the context for the remaining discussion. So, as has been mentioned over the last year and particularly over the last couple of months since the collapse of Lehman Brothers, we've been hit by negative financial news almost on a daily basis. And now the worries about the financial sector are turning into serious worries about the real economy. And governments around the world are scrambling with different measures to prop up banks and prevent further damage to the economy. So later, Professor Graham will elaborate more on the government responses to the current crisis. But maybe the first question that comes to mind is like, how did we get here, right? How did we get to this situation? And it's a very long question to answer in such a short panel, so I'll just try to briefly summarize the situation by saying that it all started with the housing bubble in the US, as we all know. And as this picture actually summarizes, we see that the collapse of housing prices caused a collapse of many securities that are related to the mortgages in the housing markets. And these securities, like the CDOs and the mortgage-backed securities that have been increasingly used by financial institutions and sold to investors around the world, the collapse in prices of these securities led to big problems of liquidities and solvency in banks in the US that also spread to Europe, and that were also, these countries were also, in the meantime, struggling with their own housing bubble. So as you see from the picture, there are many participants and they all have their shares of the blame. And we all want to know, who's to blame. And it's a very complicated question that will be debated for years to come and will be the subject of research in the future, for sure. Now, as you see, I'm going to point out, so rather than talking about all the causes of the crisis, I'll point out two major points here. And the first one is, as you can see from this chart, is that in the beginning of 2000, the US Federal Bank started decreasing interest rate dramatically to stimulate the economy after the dot-com bubble. So this provided really very cheap liquidities to both individuals and businesses and financial institutions. Now, in particular, Wall Street banks, so taking advantage of this cheap cost of funding and also to invest in these securities that yield high returns, most of the Wall Street banks and other financial institutions took on very high levels of debt. So the chart on your right shows you the level of leverage of some of the Wall Street banks, and you can see that some of them had leverage of 30 times the level of their equity, basically. So this, of course, created the big problem for the banks, as you all know. And one of the problems that that the markets will be faced with this, after all this, is the deleveraging, a cycle of deleveraging by both consumers and financial institutions, combined with the pricing declines and investor redemption that will cause serious problem in the financial market. The other point that is worth mentioning in terms of some of the factors that exacerbated this crisis, it has been, the debate since the near collapse of AIG has been in the area of derivatives markets. So in particular, what is known as credit default swaps. These products that allow bond investors to protect themselves against corporate default. And as you can see from this picture, it's a very complicated market where participants are highly interconnected, which makes the failure of one becomes really a problem to the whole financial system. And you see from this chart that, banks, insurance companies, hedge funds, mutual funds, companies, they're all linked together through the use of these highly sophisticated derivatives markets. So there are, of course, many other reasons, right? And it's, the debate has been around, the role of credit agency, rating agencies, securitization, lots of causes. But the most important thing now is, what is the impact on the financial institution and on the real economy? And As you see, in terms of the impact on banks, it has been really devastating for major banks around the world. So losses, credit losses from banks and insurance companies reached almost $1 trillion over the course since 2007, and the revised IMF estimate takes that number to 1.4 trillion. The banking system has been completely reshaped, with many banks going bankrupt, others being bought, others being nationalized, other banks changing business model. And the consequence, of course, is the tightening of the credit condition, as will be explained more in detail by Tom Siemens a little later. The stock market has also been suffering the consequences of the credit tightening and the financial crisis. So, for instance, in terms of the volatility, which reached a record high during the last few months, in particular in the month of October, you can see from this chart that the number of days where the S&P 500 index closed at either up or down by more than 4%, reached really a record high. And that's, to put things into perspective, you see that it's even more than the number for the 1929 stock market crash and the following years of depression. This is not just in the US. Of course, in Canada, actually, that number was 11 instead of 9, so the volatility was higher in Canada than in the US. And as you can see from the next graph, the world market index lost almost 40% of its value just from the beginning of the year. So there's a lot of wealth that has been actually lost during only a few months. So this takes me to the most important question that will be debated in this evening, which is the impact on the real economy. And the debate has been between whether we will be in recession or depression. And if you see in this graph here, this is a picture that has been published by The Economist magazine in October. And this index just depicts the number of economy-related articles published in Wall Street Journal and New York Times and the Times of London that talks about depression. So there's a really serious debate about whether we'll be in depression or a recession. And you see that this number was really high compared to previous periods of recession, which gives us really reason to be concerned. To be on the optimist side, one can think of recession, right? And it seems now, you know, that all the numbers indicate a real possibility of a global recession. So the Eurozone is officially into recession. The last number I saw yesterday for Japan, it's entering a period of recession, which is defined as 2 consecutive quarters of negative GDP growth. The numbers for the US are also not good. And so the question then becomes how long and how deep this recession is expected to be. And just to give you some indication, in a recent speech by the governor of the Bank of England, he was trying to be reassuring to the market by saying that the recession in England will be more similar in its shape to the Swedish experience rather than to the last decade type of crisis in Japan. And, so if he was really trying to be reassuring. Now, what happened in Sweden? In Sweden in 1990, there was a banking crisis followed by a recession. The economy contracted by almost 5%, and the recession lasted from 1990 to 1993, which is, you know, for most of you, it's long enough to be a source of concern, of course. And so Japan had a very similar experience, and lots of parallels has been drawn with the experience of Japan. It started with the housing bubble that led to a banking crisis, and further to that, despite all the efforts of governments to intervene and save the banking sector, still Japan went through a long period of 13 years of stagnation inflation and deflation. Now, if you think of the Japanese stock market, index being at a level of 38,900 in December of 1989, you see that today, 18 years later, the stock market index is, I think today it was 8,300. So, I mean, still we haven't even recovered to the level of, so shares have been trading at a fifth of their value compared to the peak before the recession. So I guess, I mean, this is the outlook for the world economy. Numbers are not very good. Perhaps in Canada we're in a better position, but this will be debated more by the rest of the speakers here. Thank you very much.